To shed more light, though, on this economic collapse of Silicon Valley Bank, we are joined by economist Mitch Roschelle. Mitch, thank you very much for joining us. It is quite a day in economic news because not just is it Silicon Valley Bank from Friday, but we just learned overnight that Signature Bank in New York City, which was heavily involved in financing crypto, that has been shuttered as well, at least for the time being. So the question is, Silicon Valley Bank, is it a one-off? I guess not. Or is it a canary in the coal mine and something that is a symptom of worse situations to come?
Let's break down why it happened, and then maybe that'll shed some light on whether or not it's a canary in a coal mine. I don't know how big the coal mine is, but in part, I think it is. So there's two things that cause banks to fail. And when we go back to 2008, those banks failed because of credit risk. Basically, they made investments that weren't good, and the value of those investments were nowhere near the what they had them on the books for, right? So that's what I'll call credit risk. What happened here is maturity risk or liquidity risk. And what I mean by that is when you go into a bank and you make a deposit, you're actually lending money to that bank. Okay. What the banks do with that money is they invest it. Sometimes they invested in loans. Sometimes, in the case of Silicon Valley Bank, they didn't do a lot of lending. What they did was they invested the money in other securities. In fact, safe securities, invested in U.S. Treasury securities. The problem is they were buying 10-year securities. Okay. And their deposits were shorter in maturity, meaning they had a 2-year CD or they had a checking account, which is known as a demand deposit. So people could come into the bank, pull out their money, and they didn't have the liquidity. What happened when interest rates went up, and the Fed's been raising interest rates, the value of those investments, the bonds, went down, not because they were bad credit, just because of the way the markets work. When interest rates go up, the values of bonds go down. Okay, they're inverse in relationship. So when they had to start liquidating some of those bond holdings because there was a run on the bank, there was fear. That's what happened Thursday and Friday last week. The bank lost a tremendous amount of capital because they had to sell bonds at a loss. So I don't know that it's a canary in a coal mine, because I think other financial institutions do a much better job of managing that risk. Okay. But I'm sure, like we saw with Signature Bank, we're going to find other banks have problems. But to the canary in a coal mine, this is not like 2008, thankfully.
Yeah, the largest bank failure ever in the history of the United States was Washington Mutual back in September of 2008. That bank was valued at more than $300 billion. It is interesting, though, that Silicon Valley Bank was the 16th largest bank from a deposit standpoint in the country, currently at over $200 billion. But SVB focused on venture capital, Signature focused on crypto. So again, the canary in the coal mine question, were these just risky sort of investments aside from the bond maturity that you mentioned? And as long as it's just you and I having our money in big banks and keeping it there in a savings account and getting a 4% interest rate, we're not really at risk like that?
Well, let's put it this way. I can speak very personally about Silicon Valley Bank. I was involved in an investment that had money, and it wasn't venture capital, actually had money at Silicon Valley Bank, and it was set to make distributions on Friday, and boom. So I had a pretty sleepless weekend until I heard the remarks yesterday.
Well, wait, let me go deeper into that, Mitch. Sure. Does that mean you're somebody that wanted to get money out and couldn't? All your money is locked up. Not all your money, but the money in that bank specifically is locked up?
Correct. In fact, we had a wire transfer on Thursday. A bunch of the wire transfers went through. On Friday, the balance of the wire transfers were frozen. And it wasn't until, I guess, 9 o'clock in the morning that we knew that, oh, wow, they'd taken over the institution. The press release that came out on Friday said that insured deposits, meaning any individual deposit up to $250,000, would be available on Monday. But anything that was uninsured, so if you had $201,000, that $1 which wasn't insured, we didn't know if we'd get it. And so when Janet Yellen went on I guess one of the Sunday news programs and said that every depositor would have access to their funds, that was a breath of fresh air. But, and it wasn't until we got more word yesterday, we didn't even know how that mechanically was going to happen.
Thanks for watching. Go to newsnationnow.com to find News Nation in your cable lineup. And don't forget to click the red subscribe button below to get more of News Nation's fact-based, unbiased coverage.